Good morning, ladies and gentlemen. This is Butch Shorak, Options University, Friday, May 18th, 2012. Access to this webinar is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Our purpose here is to give you examples of how to apply certain strategies to the overall market so that you can attempt to make profit from that. But these are going to be your trades, and they have to be your responsibility. With that, let's take a look at the weekend that's taken place. As we see that we had very little news on Monday. Tuesday we had CPI, retail sales, Empire State Manufacturing, business inventories. All of those were not enough to make the market pop to the upside. We saw we had housing starts on Wednesday, FOMC meetings, which had little or no effect on the market on Wednesday. And of course, on Thursday, we had jobless claims, which basically came in line. Philly Fed was a little bit disappointing. Leading economic indicators also was not enough to make the movement move up. And here we are in options expiration week. And on Friday, we have no news, no economic announcements, nothing to move the market except for the market itself. And move it has done this week. And let's take a look at the SPX. As we see, it has been in a down cycle for about the last 12 days. And it has only known one movement, and that is to the downside. So we see all these red candlesticks as we're coming down, and we see huge moves in the market. As we look at ATR, our average true range, we see that it has continued to move up as the market has picked up volatility and picked up range as we've been moving down, moving out of our yellow zone up here and moving into a new zone, which may be our summer trading zone. All right, we see if we look at market forecast right here, as we look at the market forecast, we see all of our different indicators in that market forecast. The momentum, which is the shortest term, the near term, and the intermediate term lines, which are given to you by the different colors. We see that we are below that 25 mark, and therefore we are in an oversold area of the market, and we are due for a bounce. Well, of course we're due for a bounce after 12 straight days of downward cycles. So market is what it is, and it can move in great movements. And those market participants that opted to abide by that old adage, which many of us have heard, sell in May and go away, are probably pretty happy as they didn't see their bullish positions fall apart as the market's been down but roughly around 6% month to date. So quite a month as we see we've gone from 1424 up here all the way down to almost 1300. Closing down 1.5% today. In the S&P down 20 points to close at 1304, headed for that magic 1300 number. And so we see that we've had quite a pullback during the last couple of trading weeks as the market has decided to trade in a brand new range. News such as Greece, news such as JP Morgan, all of these things contributed, but it was time for a pullback. And we had been anticipating that, so it didn't come as a great surprise. Next, we'll take a look at a closer look at this, and we see the length of the candlesticks. We see that the down cycle, as we got lower highs, lower lows, lower highs, lower lows, and so on and so forth as we continue down, giving us all the way down to 1304.86, and it doesn't look like we're finished yet, as the market has established itself going outside of this range that we traded in for quite some time, that yellow range up there, that we've now established a new range. Probably will trade there during the summer, unless we go into a full bull market, but I think that's highly likely. We are due for a bounce either Friday or Monday, That, of course, doesn't guarantee we're going to get it, but be prepared for that bounce. If we take a look at the Dow, we see the Dow was down 1% today, plus down 156 points, and we see that looks just like the S&P as we're in that strong down cycle outside of its normal trading range, and we broke through, headed for that 200-day moving average there. We'll see if we actually get that far. It is possible to go to that 200-day moving average. Next, we see the NASDAQ, which was down much harder today than the other indexes, down 2%, over 60 points, as we see that it stalled out at this level right through here, and then as it headed down hard, with today leading the way down as it looked the strongest, or one might say the weakest, in this downfall. So there it is, 200-day moving average down there around 2750, currently at 2813. That 2750 is within range, and we certainly have not seen capitulation. All right, let's take next a look at the RUT. We see that it certainly had a big day today, actually hit the 200-day moving average, and the bears were happy. A little late at this point, I think, to get in on the bearish side of the market, as we are due for a bounce as indicated by that market forecast indicator, and the fact that we've been down so many days in a row. Should get some kind of relief rally here shortly, either Friday or on Monday. One would expect to see that kind of a rally. The VIX certainly has shot up as the stocks went down, and the fear index, so to say, we euphemistically call it that, is now in excess of us, up of 60% from the lows that it set just a couple months ago. As we were down here a couple months ago at the 14 level, we see now we're up here at 24, and today actually moved up more than 8%. Actually, by the time the day was over, up 10% for the day. Quite a move for the VIX as the fear moved into the market and increased that volatility, which of course affects our option pricing. And so if you were an option trader today, you could see the kind of volatility that was there and the kind of premium. Next, we look at the bonds, which we would expect to bounce up. Went up into all-time highs for the year, and we see that we're up there around 124, as evidenced by our ETF TLT. And we see that the bonds have jumped up, and they did it on huge volume today on Thursday, as we see that it took quite a jump up, as there was some kind of escaping to safety looking for those bonds. Next, we're going to look at another ETF, the XLF, which of course is our financials. With all the bad news that we've been having with the financials, of course, we dropped out of that last couple of months trading range, which was from 16 to 15, and now are all the way down to 14. Led by the news of JP Morgan, we've seen this drop out of bed and actually break through some previous support that we had there into lower lows, as the financials react to the news from JP Morgan of trading losses in excess of, we're talking now around $3 billion. So financials, XLF, certainly went down with the overall market. That would be expected. Very difficult to have a sustained bull market without the financials actually participating in that. Next, we're going to look at USO, an ETF that's involved with oil, can trade oil by utilizing it. And we saw that oil, crude prices were down 2.5% today to a 2012 closing low of $96.03 a barrel. Our ETF USO trades at a different price, but also is indicative of where oil goes. We're sitting here with this gap here that has not yet been filled. We're well below the 200-day moving average, as oil has sold off and has reached lows for the year so far. So keep your eye on oil, due for a bounce, but it won't bounce until it does. So we judge that by higher highs and higher lows. All right, it definitely is in a downtrend. Same thing with gold, which finally there was some flight to safety, if one considers gold safety today, as we saw a big old white candlestick as the market in gold, which we see GLD, which is an ETF for it. We see that we've taken them from our down cycle that we were in for 1, 2, 3, 4, 5, 6, 7, basically around 7 days. Had a big move up today as the market pulled back as a potential safe haven from equities. Now we'll take a look, see what kind of volume we had, and we saw that at 247 million on the SPDR, the SPY, which is our ETF for the S&P 500. We see that we are headed for that 200-day moving average. Haven't quite reached it on the SPY yet, but we had 150% of average volume as we had a big volume day with this huge candle sell-off that took place today in the SPDR, indicating that that could have been an exhaustion sell-off. Still looking at 1300 or this 130 level as a potential, as we have seen much strength in this down cycle after 12 days. Still a big move today. So with that, that's the week that we've had so far to this point. And for those of you that are gold members, we'll be looking at charts on some of the other stocks that we watch and have been watching, looking for potential entries. Which stocks would one enter if we do end up with that relief rally from this down cycle? So gold members, welcome back. We'll be back in about 2 minutes. And for the rest of you, thank you for being here. This is Butch Shorak with Options University. And for those of you that are interested, can go to more free videos at www.optionsuniversity.com/free gold. And there will be a little video that'll show you that site as we close this out. So thank you for being here, ladies and gentlemen. This is Butch Shorak, Options University, Friday, May 18th, 2012.